In the case of Silicon Valley Bank, it was an egregious abandonment of one of the most fundamental rules of banking. They had a lot of 20-year maturity bonds, and all the funding was deposits, which have a 0-day maturity. So they were a sitting duck. They were a sitting duck. Now, why did they do that? They were chasing yield.
Richard Vague is the author of his latest book, The Paradox of Debt, which presents a new view on macroeconomics, and it was just released last month. It's become a Wall Street, USA Today, and Amazon bestseller. He is also the author of numerous other books, The Case for a Debt Jubilee, An Illustrated Business History of the United States, A Brief History of Doom, and The Next Economic Disaster, a book with a new approach for predicting and preventing financial crises. Richard also serves as managing partner of Gabriel Investments, an early-stage venture capital company. He previously served as Secretary of Banking and Securities for the Commonwealth of Pennsylvania, as chair of the Pennsylvania Housing Finance Agency, and as board trustee for Pennsylvania's two largest pension funds, the Public School Employees Retirement System and the Pennsylvania State Employees Retirement System. He was also co-founder, chairman, and CEO of Energy Plus, an electricity and natural gas supply company, and co-founder and CEO of two consumer credit card banks, First USA and Juniper Bank. Richard currently serves on the University of Pennsylvania Board of Trustees and Penn Medicine Board of Trustees, and on a number of business boards. And frankly, the list can go on and on with accolades as far as what Richard has been doing throughout his life. Richard, welcome. Thank you very much for taking the time. Congratulations on your Wall Street Journal, USA Today, and Amazon bestseller, The Paradox of Debt.
It's such a privilege to be here. Thank you for having me.
So first of all, for our viewers, give us a brief overview of the book.
Well, we call it The Paradox of Debt for a reason. Debt is the creator and the destroyer. Economies can't grow without debt. Debt actually creates money and wealth, and we get into that fairly deeply. But debt also is the destroyer. It brought such things as the 2008 financial crisis. It's the kind of thing that, as it accumulates, can weigh down an economy and slow economic growth. And I think equally importantly, debt growth creates increased levels of inequality. And we get into the actual mechanics of that. So we try to show the whole picture, which I think is a very important picture for folks to understand.
You've written a lot of books about debt. This is not your first one, including The Next Economic Disaster. From when you've written those books to where we are today in 2023, heading towards the fourth quarter here, what are some of the differences that you see from when you originally wrote your first books to where we are now?
Well, we started on this journey because of the great financial crisis of 2008. And so all of our early work was around private sector debt and the fact that a rapid accumulation of private sector debt was really always the culprit for a banking crisis. And one of our books, The Brief History of Doom, I didn't name any of these, by the way, was a history of the 43 largest financial crises in the 6 largest economies in the world over the past 200 years. And we went in specifically to make sure that there was this commonality. It's whether you're talking Austria in 1873 or the US in 1929 or Japan in 1998. It was the rapid accumulation of irresponsible accumulation of private sector debt that brought financial crisis and banking crisis and the like. So that was really a lot of our early work. But, you know, there was a little nagging item for us every time we did that. And that was, you know, we're looking at debt, but what about the assets? And shouldn't we be looking at assets and liabilities together? So this book is really doing that, stepping back and looking at the entire balance sheet of the 7 largest countries in the world and the subcomponents. So, in a given economy like the US, you have the national assets and liabilities, but you can break it down quite usefully into businesses and households and government and so forth. And so we have done that, and it's really kind of a natural financial analysis. And when you do that, it's more what a financial analyst would do than an economist would do. Let's look at income and balance sheet trends through time. And as you do that, all sorts of very productive things start falling out. And some of the ideas I said at the outset in terms of debt creating wealth and so forth really emerge very clearly once you start doing that type of analysis.
It's interesting that you mention it. And also, in regards to your book, you talk about taking a holistic approach, understanding, what drives both financial crises and spiraling inequality. You've combined those both, which is very much a part of our discussion today. And there's almost I would call it a vein of populism that I'm seeing from people today that I would have otherwise never have thought to be talking about these issues 5-10 years ago. And I think with the barometer that we're seeing with inflation, we're seeing Moody's and other rating agencies downgrading banks. They're concerned about commercial real estate debt. We're seeing an ever-increasing amount of personal credit card debt, car loans, student loans, and the like. All of this is now seeming to be front and center in the discussions from people who otherwise would consider themselves free market capitalists in that vein, but also discussions on how we can fix this, how we can make it more equitable for the mom and pop small business owner who really doesn't stand a chance against the large Fortune 500 corporations that seem to have their tentacles deep within the regulatory agencies and our politicians. And this isn't just in the United States, but as you discussed, the 7 largest countries, it is worldwide, correct?
It's absolutely worldwide. You see essentially the same phenomenon no matter where you go. And in some places like China right now, they've taken it too far and they're beginning to have their own financial crises, but the fundamentals are the same. I would say, you talk about free market, and I've always, I was a business person forever and ever, and I kind of always assumed that was the case, and that was the belief that I should have. But what I think we really are here is empiricists. The data's there. Not many people really dig into the data holistically. We know that because when we go get the data from the World Bank or the OECD and others, there's a lot of aspects on the asset side of the balance sheet that it's clear nobody's been looking at. The questions we ask, the analysts that are providing this, it's clear we're the first folks to have asked that question. So it really emanates from the data, and the startling fact, and I guess we knew this, but I think as we dug into it, it became so emphatically clear, is the top 10% of the population own 65% of all the stocks and real estate in the country, and the bottom 60%, 60%, only own 14%. So as increased debt drives up asset values, which is what it does, inequality widens, and that is a feature or a function of the system as it's built. So inequality has increased a startling amount in our lifetimes, and it's really clear.
From your macro perspective, and I know you get very micro within your books, but from your macro perspective, again, you've been writing books about this now for some time, and here at Valcor and our associates have been working with companies and businesses doing restructuring, debt restructuring, working with banks, trying to keep small to medium-sized businesses alive and survive. What is the difference between where we are right now? We all remember 2008 to 2009 and 10 in our rearview mirror. It seems very recent almost for us. The policies that were implemented with basically ZIRP, zero interest rate policy by the Federal Reserve, and pumping up the economy with free money over the past 13, 14 years came to a stop this year. And you've seen the Federal Reserve raise interest rates exponentially almost. There's discussions they may raise it a little bit more and maybe hold off for a while. We may not see reductions in interest rates for maybe a year, maybe longer. We don't know. But what impact have you seen from a macro perspective, and what the difference is between where we are today, many people believing that we are now heading into a different kind of financial crisis than we had in 2008, but a financial crisis, albeit. What is the difference in your mind as from a historical and present day perspective?
And are you speaking mainly about the high interest rates versus the zero interest rates, or is your question?
Well, I think, again, from a macro perspective, it's kind of a potpourri of all kinds of issues. So you've got the high interest rates where it's causing a tremendous consternation regarding debt service. From what we understand, about 50% of all commercial real estate portfolios are going to be refinanced, or the terms are coming due over the next 2 years. And banks, which many of which have been downgraded in recent months, are looking at this as, basically a tsunami that's about to crash on the shore. And so that has decreased their appetite to lend. Risk aversion has increased, and it's slowed down people's ability to finance their businesses. That's just one perspective that we're hearing from many of our small business owners.
Well, I would be in the camp that says that the increases in interest rates that the Fed has imposed have not been necessary. It's been a fairly dramatic overkill. And we watch inflation very, very carefully. High inflation more or less ended 13 months ago. It dropped from 9%, and we look at it on a monthly basis. So the monthly inflation in July and August of last year plunged from 9% down to 0 to 3%. And in the 13 months since then, it has averaged about 3.1%. So high inflation is over. Now you can argue whether it ought to be 3 or 2, but that's not a huge argument. And it dropped when interest rates were 2%. Interest rates were 2% last summer, and they're 5.5% at the moment. So all that difference is pain that the Fed is inflicting, and inflicting, in our view, unnecessarily and inappropriately. Now that doesn't help us because the Fed's the Fed, and that's what's going to happen. One of the big consequences of the high interest rates is a redistributive consequence. For every expense, there's income. So when interest rates are high, there are losers. Clearly, someone who's leveraged up a commercial building expecting interest rates to be yay high, and they're twice that level now, is a loser. But again, the holders of financial assets, which by and large are the wealthiest 10% or so of the population, are their cash flows increasing because of this. So, and the little guy on the household side is being hurt, I think, fairly significantly. Not just mortgage rates, but their credit card rates and so forth. So I think that the Fed is inflicting a lot of damage on the economy that's entirely unnecessary. And, so your concern about the repercussions of that, I think, is justified. And you guys will, I think, be dealing with a lot of the casualties that come from that. And I want to say one more thing here, and that is, in 1980, in the heyday of Milton Friedman, we didn't have a lot of data to make an analysis of inflation. But today we have a lot. We've got a database of 47 of the largest countries in the world where you have information on government debt, on money supply, on private debt, on inflation. It goes back, in most cases, at least 50 years, in some cases 70 or more years. So it's very easy to make an empirical determination about what is true and not true about inflation. And the simple fact is, you can go find every instance of high money supply growth and then see whether it was followed by inflation or not. And the bare facts are there's been, over 30 such instances, and they've been followed by inflation, I think, like 7 times. So, less than a quarter of the time. And conversely, there have been a lot of instances of inflation that weren't preceded by high money growth. Same exact analysis can be done for high government debt growth. And by the way, high money supply growth and high government debt growth are two very different things. They're not the same thing at all. But, since folks conflate them, you can go do that same analysis and you'll find the same thing, that high government debt growth is not followed by inflation very often, and inflation often occurs without it. So I think we need to get rid of this patently false idea that seems to be pervasive, that, profligate money supply growth is bringing inflation. What brought inflation was COVID, with millions of workers, unable to go to the factory and build the widgets. And then this little thing called the Ukraine war that, just happened to have combatants that supply a lot of the grain and oil and natural gas to the world. And that's coming down now, and hopefully we'll stay in a more reasonable range.
Richard, I guess I understand exactly what you're talking about and discussing. There's definitely a big difference between having low interest rates available by banks for people to borrow debt, to buy real estate, invest in equipment, and such like that. And that's debt that is serviceable by the private sector. And you're comparing it to national debts, government debts, which right now is $32 trillion. And there's budgets in place right now that, if they're not changed, we can see that reach about $50 trillion within a decade, from what I'm understanding. And correct me if I'm wrong on that. However, the significant difference is when the private sector is servicing their own individual debt, that either based upon the interest rates and the debt service itself allows for more money or less money, depending upon interest rate levels for that individual company or individual person. When we're talking about sovereign debt, when we're talking about government debt, the difference there is the impact that it has on other spending. And when we talk about servicing the interest rates at a relatively high rate right now in a government debt, national debt, and the cost of servicing that interest rate, that, from what I understand, takes money away from services, public services, fighting wars. And then the exponential snowball impact of that is, well, we got to borrow more. We got to give more to Ukraine, or whatever the cause is in that moment. So I understand what you're talking about are two different things. But at the end of the day, when you're talking about government servicing, government services being cut, or whatever it may be, people talk about Social Security and Medicare as well. Doesn't that all kind of fall into the same stew, if you will, of the small to medium-sized business owner who's just trying to run a business and pay their taxes and, service their own debt, and then finding that there's less infrastructure or whatever it may be combined?
Well, you're absolutely right when you say that government spending in this area over here has the likely outcome of less spending over there. And I think that you're absolutely right in thinking that one of the places where our parsimony has hurt us is infrastructure, for example. I mean, it's been a little embarrassing looking at our roads and bridges and airports compared to lots of other countries in the world.
Yes.
So there are those practical trade-offs being made, and it's problematic. But I do want to step back and talk macroeconomically about government debt. Government debt actually creates wealth. In the 3 years of the pandemic, government debt grew $8 trillion, which is a startling number, of course. In that same 3-year period, 20 to 22, household wealth increased by $30 trillion. That's because when the government spends money, it doesn't disappear. It actually largely goes into household checking accounts. So, we can show that the book actually goes through this math for you. It shows up in household balance sheets as, a financial asset. And the other, so 8 trillion in increased household wealth came from government spending. The other 22 trillion was this increase in money caused asset prices to go up. Real estate and stocks being the predominant two assets in the world. And they went up by over $20 trillion. So households got way wealthier. The problem, as I mentioned a moment ago, was that most of this wealth went to the top 10% and almost none of it went to the others. I want to give you one more number here. In 1980, total debt in the economy was 125% of GDP. Today, it's over 260% of GDP.
Mm-hmm.
Total wealth of households in 1980 was 350% of GDP. Today, it's 600% of GDP. The explosion in debt is causal in the increase in wealth among households. Is just very unevenly distributed. And by the way, the number today is household wealth in the US is $150 trillion. Government debt's $32 trillion. If government debt was zero, household wealth would be $118 trillion. That wealth just resides in the balance of households. We need to understand this. Now, that doesn't help. Most politicians don't believe that or don't, follow that or don't appreciate it. So we are left with the trade-offs that you talked about in terms of policy priorities. And everything I just said doesn't change that debate.
So what do you say to those that argue that, yes, there was a tremendous amount of, let's call it the Federal Reserve printing press during COVID? It was, many people will say it was absolutely necessary. Due to imposed lockdowns, business owners could not earn any money. People were basically without any income for quite some time. So they had to provide stimulus. They had to do what they needed to do. Put that to the side for a minute. That is not sustainable. Are you saying that if the government is able to print money and do what it needs to do, that it will only benefit? Does that not devalue the currency or the fiat?
So I want to separate two things out very, very clearly.
Okay.
What the government did in COVID, which I generally applaud, is it did something fiscally, which is it sent $1,200 checks out and then it sent $1,400 checks out. That made up for the shortfall in spending that came with COVID. That's one thing. That's government spending. That does not increase the money supply, by the way, but it does so save folks who are in peril. The other thing the government did was buy securities in the open market through the Federal Reserve. So one of them is Congress over here writing $1,200 checks. The other is the Fed buying Treasury securities. The Fed buying Treasury securities
QE
helps stabilize. That's open market operations. That's quantitative easing, as they call it. That doesn't increase the amount of money available for spending in the economy, period.
That's a lot of it went to the banks.
A lot of it went it's all it is. If you owned, $100,000 Treasury bill and the Fed bought that from you in an open market operation, all of a sudden you're going to have $100,000 deposit, or you're going to buy a mortgage security with it, or you're going to buy stock with it, or whatever. You've got $100,000 in savings in the form of a T-bill before the open market operation. You've got $100,000 in savings in some other form. It's not going to change your spending habits. Not going to change anybody's spending habits. It's just swapping out one kind of an asset for another. So I think the misunderstanding around that is profound. What the Fed is doing is stabilizing financial asset markets when it does that. If it comes in and buys treasuries, if it comes in and buys mortgage securities, you may remember in the pandemic, it actually came in and bought municipal securities for a brief period. All it was doing, it wasn't supplying the municipalities with more money. It was solidifying and stabilizing the market. What, Walter Bagehot 100 and something years ago called being the lender of last resort. It's not supplying money. It's not printing money. It's not supplying spending money. It's stabilizing financial markets.
In our last few minutes here, and I greatly appreciate you taking the time, Richard, in your book, you discuss the policy areas that you'd recommend, ranging from trade to housing to financial policy and student debt. As I mentioned earlier, we've got approximately 200 banks that surveys are showing that could be in trouble if there is a bank run. There's about 30 different banks right now, according to Moody's, that are either been downgraded or about to be downgraded. Some of them are very large banks. So looking forward in the next 6, 12, 18 months, and forgetting about the political implications of whoever, whatever wins an election next year, what would some of these policy areas range from? What would you recommend whoever is in the White House and in Congress over the next couple of years to implement?
Well, can we talk about those banks specifically for a moment?
Sure.
My first job after being a dishwasher was being an account analyst at a bank. This was back in 1976, I believe.
Not to age yourself.
Not to age myself. One of my very first responsibilities was running a federal funds desk when Paul Volcker pushed interest rates up to 20%. So I've lost my train of thought here.
But you were talking about the banks.
Well, one of the first things you learn, there's 2 or 3 things you learn that are axioms of banking. They're absolutely fundamental to running a bank. And one of them is, it's like the ABCs of banking. One of them is you match assets and liabilities for maturity purposes to eliminate interest rate risk. So if you buy a 10-year treasury bond, you need to have a 10-year CD in place of equal size so that when rates go up, you aren't hammered. And if you aren't going to buy a 10-year CD to fund that, don't buy a 10-year treasury bond. Buy a 5-year treasury bond or a 1-year treasury bond or a 90-day treasury bond. One of my first jobs before there was Excel spreadsheets was preparing the asset and liability spreadsheet. And if you were out of balance, the regulator came in and marked you down. You didn't get a 5. You got a worse rating. And in the case of Silicon Valley Bank, it was an egregious abandonment of one of the most fundamental rules of banking. They had a lot of 20-year maturity bonds, and all the funding was deposits, which have a 0-day maturity. So they were a sitting duck. Now, why did they do that? They were chasing yield. And this is the temptation that gets banks into trouble over and over and over again. And it certainly did. And you have to ask yourself, and I was a bank regulator. I was the chief regulator of Pennsylvania's banks for 3 years. But I've been on both sides of that equation. I've been examined and I've been an examiner. For 30 years of my career, I was the one that the examiner was coming in and fussing at. And by the way, we had discussions about asset and liability management every time. And I got criticized and I had to fix things more than once. So how in the world did Silicon Valley Bank do this? How did they get away with it? Not just their management, not just their board, but the California regulators and the Federal Reserve regulators. How did that happen? And I don't want to spend too much time on this, but I'll give you one little anecdote. And that is It comes from the 1980s. It was a bank called Lincoln Savings.
Yep, I remember that.
Charles Keating, and he was in cahoots with Michael Milken in buying junk bonds into his portfolio. And by the way, there was an explicit regulation saying you cannot own more than X much junk bonds in your portfolio. And he was at 2 or 3 times that level. And the poor, hapless regulator, Edwin Gray, who tried to stop him, well, Charles Keating, who had just made a lot of political contributions to, D. Concini and, who's our Arizona senator?
McCain was involved in that.
John McCain.
Yeah.
There were 5 senators that came down on poor Edwin Gray and got him fired for enforcing a regulation that should have been there in place. And he was replaced by a much more compliant individual named Danny Wall. And he kept his misbehavior going, and it cost taxpayers $1 billion a couple of years later. So I do not know this, but I speculate that in the case of Silicon Valley, you had these poor little regulators going in to this glamorous Silicon Valley bank where you had, influencers like Peter Thiel and Mark Andreessen and so forth and so on, who, either on the board or, and the little regulator didn't have a chance against that kind of social pressure.
Yeah.
So, I don't want to go overboard here, but I think you talk about this is not indicative of a systemic credit problem or financial problem in the U.S. system. It is a subset of banks who made a bad decision. By the way, the Fed can solve this problem overnight by lowering interest rates. The Fed couldn't solve the credit problem in 2008. Fed can solve this problem like that.
Right. I think that goes back to Greenspan after 9/11 deciding to lower interest rates in response to obviously the attack on our financial system and not wanting to see a flight of capital out of the United States by our foreign investors. And that's why he did what he did. But I don't think anybody, Bernanke, Yellen, any of them assumed that would continue for 20 years, zero interest rate policy. But as you stated, you've been involved with, you served as Secretary of Banking and Securities for Pennsylvania. I think you started 2 consumer credit card companies, didn't you? So just from a Pennsylvania perspective, real quickly, one of the banks that's included on this risk list, if you will, where they're negative, is PNC. I know PNC very well. A family member of mine is very high up in that bank. You've seen Capital One Financial Corporation, Citizens Financial. These aren't small regional, podunk banks. So is it not systemic? Is it just related to the bad decisions by regulators in California for Silicon Valley Bank, or is it something else that we're seeing?
Well, I think there's a way to make that assessment, and that is, and it's real obvious, and it's kind of back of the napkin, but I think we can estimate in aggregate. I think there's enough data out there to estimate in aggregate that this problem is a several $100 billion problem, right? I don't know if I haven't seen the number most recently, but let's call it 500 billion.
Okay.
The system has $2.2 trillion in capital in it. So, worst case, it's going to be bad, but it's not going to be fatal.
Yeah.
And, they'll have time to work through it and this and that and the other. That compares to 2008, when there was about $1.5 trillion in capital. And the mortgage industry had made $5 trillion worth of loans in a compressed 4-year period. At least 2 to 3 trillion of those were substandard mortgages.
Right. So
to me, your worst case there was more than 100% of the capital in the system. Today, your worst case is maybe a quarter of the capital in the system.
Until we start taking a look at commercial real estate, which, what do they say? History doesn't repeat itself, but it rhymes. So, I don't think you can go back to 1981 with the financial crisis. Then we could take a look at what happened in and around the millennium, first with the dot-com collapse and then 9/11, and then we had some obviously 2008. They were all intrinsically different, but at the same time, as you have correctly stated, it's the people that could least afford it that get hurt the most. And I applaud your efforts to try to find solutions to protect those individuals so that you can have some more equality and equity within this economic system, with all of its flaws and warts, I should say, is still comparatively the best in the world. So, in my opinion, I know some.
And by the way, that you can make that conclusion empirically as well. We track the top 7 countries in the world, who, by the way, collectively constitute 2/3 of all global GDP.
Yeah,
just 7 countries, and we do look better than everybody else, as it turns out. But back to this issue on systemic, I think you're thinking about it and approaching it the right way. But I do think even that commercial office space risk, if you come up with a worst case there and a worst case on the bond market, which we do, you're still looking at something that's tolerable in the context of 2.2 trillion in capital. It's not pretty.
No, it's going to hurt, and there will be contagion. Almost certainly there will be contagion, because banks are going to get hurt, and they're going to, again, our demographic, who we serve for the last 3 decades, is the small to medium-sized business owner. And when they can't get access to capital, loans, business loans, equipment loans, commercial real estate loans, whatever it may be, because the banks have become a lot more risk adverse because they're getting really hurt by one sector, that's where we see the economic impact. Richard, I know that we have a hard
time. Can I say one other thing?
Yeah, please.
At risk. You're exactly right. And one of the things we demonstrate in the book is that GDP growth is actually is a function of bank lending.
Mm-hmm.
So if banks, and there's 2 kinds of bank loans. One is loans for spending. So if a bank makes a loan to build a new factory, that's a loan for spending, versus a loan to acquire an older asset, an existing asset. All the loans for spending translate directly into GDP growth. So if the economy grows $1.5 trillion this year, that's because there was $1.5 trillion worth of loans. They match each other. We actually have a chart in there that shows through time how those things. So it follows that if banks pull in their horns and net lending increase is 0 or $0.5 trillion instead of a couple of trillion, that means we'll have a recession or effectively 0 GDP growth. And that's, I think, a bona fide risk that you've articulated well.
Richard, greatly appreciate you taking the time. The Paradox of Debt, A New Path to Prosperity Without Crisis. It is a bestseller, just came out last month with Wall Street Journal, USA Today, and Amazon. Tell everybody where they could learn more, find the book, and learn more about you, please.
Well, thank you. You obviously can go to Amazon or Barnes & Noble. We have a website, paradoxofdebt.com, and we'd like folks that are serious about this subject. I think they'll get a lot of benefit from this book.
Well, thank you, good sir.
You've got by far the most thoughtful show out there. I've done 100 of these things, and
my goodness!
But your understanding of the issues and the thoughtfulness of your analysis is head and shoulders above everything else.
I appreciate that feedback. Thank you so much. Greatly appreciate you taking the time, Richard. Wish you the best, and have a great rest of the week.
I sure appreciate being on your show.
Thank you.